Today, the good, the bad and the very ugly with Tony Locantro. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and property news with a distinctively Australian flavour. Today I'm joined again by Tony Locantro from Perth and from Alto Capital. Hi Tony.
Good evening Martin and good evening viewers.
And congratulations on the superb picture tonight as well. So we've improved the audio, we've improved the picture, and of course the content was also perfect previously, so all good.
Yeah, well, I've noticed in a lot of American TV shows they have a lot of lamps, and the only thing missing from this unit, because I live in a unit, was lamps. So we've added a few lamps, we've got rid of a few throw rugs. I've made a huge investment in making it more aesthetically pleasing, but probably one of the most pleasing aspects is, Martin, life's almost back to normal here in WA. We had 24,000 people today at Optus Stadium. The city of Perth has shut down the free parking as well. So we could park as per the limit. Now we have to pay for parking. But as I've seen in the eastern states, some activities here, it's as risky as choosing Indian for a third date, I think. I just think, look, we're surviving it, but I'm not hopeful. I can see another restrictions coming to Perth. I'm prepared pretty much to work from home now. We've seen some of these ridiculous clusters over east, like Thai restaurants and someone that went to 5 different churches and security guards doing the wrong thing. I mean, that's ridiculous. I mean, these are people's lives. And one of the most ridiculous things I did see, Martin, was people lining up for a tray of glazed donuts. Unbelievable. And I think the point is these people could probably bill $300 an hour, yet they wait 2 hours for $28 worth of trans fat. So go figure, the world's gone crazy. But I promised viewers a positive slant. And what I'm seeing is markets don't all capitulate in one hit, as you know. So I think you've got a lot of people staying at home, incomes have dried up, people are bored, so they're playing the stock market. And, we've had stocks rise 1,000 to 1,200% in one day. They've slowed down, but, geez, this trading activity's certainly getting interesting. The stock market has totally broken away from economic reality, Martin. As you know, there's just no basis for it. I mean, we have stocks after pay still up around $69. The PE ratios that non-existent. That whole buy now, pay later sector's gone absolutely nuts. But from my perspective, I haven't been this busy in years. I specialise in small cap stocks. Look, viewers, I guess they've got to take it or leave it. It's very niche what I'm doing. But only a few weeks ago, we managed to get a 1,000% return in a dog cancer company where the pill appears to extend the life of a dog. So that's what you can achieve. So I'm happy to provide viewers with some stocks that I think will do very well over the next 12 to 18 months, if you'd like to run through them.
Yeah, well, let's do that in a second. I guess just standing back, WA has done significantly better than the other states in terms of coping with COVID so far. I mean, they had a couple of new cases today, but they were, people returning and locked away, so that's not too much of an issue. I have to say that in the eastern states, the lack of discipline and the lack of focus in some areas is really costing the economy dear. So it'll be very interesting to see whether we can actually wrangle COVID back down to come closer to WA, or whether in fact WA goes the other way. So it's not over till it's over. But meantime, you're right about the markets. Crazy. A lot of new people getting stock trading accounts and speculating and riding it up and thinking that this is so easy, it's easy money all the time. Until it won't be. I was talking to Harry Dent the other day, and he's calling the top on the Nasdaq at the moment. He thinks it's reached a point where it can't go any higher. So we'll see about that. But I think the small caps sector is just something which a lot of people really don't understand and really have no idea about. So why don't we just spend a little bit of time there and then perhaps go on to some broader topics.
Absolutely. And I think I always look for risk reward. So I say to people, look, this has got 400-500% upside, 30 to 40% downside. Because in some of these stocks, they're so illiquid, someone could sell for it to pay for a divorce because they're in a bad mood and the stock will drop 30%. So that's what you're up against. So I guess people have to look beyond that. I look after roughly 170 people, and I have to manage each and every one of them, because humans are wired to buy high and sell low. That's what we're wired to do. So that's quite a tough process. But look, I just think that regardless of economic conditions, regardless of property markets, there's always going to be small companies that become bigger ones. So I'm just going to give people a list of stocks to watch. They can go away and do their own research. I have substantial holdings in all these companies that I'm about to mention. I'm going to rattle off 10 fairly quickly. So, first one is Narada. This is my cholesterol inhibitor stock, which actually had a great result. They proved that their drug in a human cell was effective as the FDA-approved drugs in the States. So this stock went from 17.5 cents to 37 cents in a day. Pip traders got hold of it, and then suddenly it's back at 19 cents. So I've actually increased my position in Narada. So 19 cents. I think that's a great story. If they can get the science right, they've got the people in the States, Christopher Cox, who was in the medicines company, which was the subject of a $14 billion takeover in cholesterol, and John Moore. So I think that the market did it kind of gave the stock the kudos it deserved, but it's given it all back, and that cholesterol inhibitor looks great. So NYR. The second stock is Adalta. Code is 1AD. This is my stock that's involved in idiopathic pulmonary fibrosis. They have an alliance with GE Healthcare, and they've just announced that they've just dosed their first patient in a trial of AD214, and idiopathic pulmonary fibrosis kills you in 3 to 5 years. So this is what they're looking at, and GE Healthcare aren't there for a picnic. So this is trading at 11.5 cents. It did touch 15 when they announced that dosing. So I think that's a really attractive buy level, Adalta. Next one's Exopharm, EX1. Exosomes and engineered exosomes, I believe, are potentially a new class of medicines. So this is huge, and they've put out an in-depth presentation. Ian Dixon and Chris Baldwin, I think, are two of the best in the biotech industry. I must disclose, Martin, that I'm the 4th largest shareholder in this company, but I'm continuing to buy. It's not as if viewers will come in and cop all our stock at 30 cents. No, I'm still a buyer. But I think Mesoblast started somewhere, and look where it is now. CSL started somewhere. I'm not saying that this could do that, but you need to have a crack. So Exopharm, EX1's a code. And Dimerix, probably one of our big success stories. This stock I mentioned here went from 12 cents to 60. They have had success with their chronic kidney disease drug, DMX200. We're going to get results shortly, but they got a free global clinical trial and a free shot at COVID. Unbelievable, worth millions of dollars. So amazing how who could endorse a kidney drug for COVID. Unbelievable. So Dimerix DXB. Next one was our 1,000%er Martin Pharmost, which announced success in phase 2 of a pill that doesn't cure your dog's cancer. It stops the tumour, gives some more life rather than putting a dog through chemo and having your carpet soiled. They've also announced some success in COVID. And I think it's the Walter and Eliza Hall Institute in Melbourne, Mark Pellegrini, said their COVID initial results were remarkable. So they're trading around 19 cents. I should disclose to viewers that we have a large percentage of the company, and we have been taking profits, but I'm not there to smash it. If it runs up to 30, of course, we're going to let a few go. Next stop, Proteomics International Laboratories, PIQ. This is one I've covered here before. They got up to 60 cents. They're currently 52. Their ProMarker D, which predicts diabetic chronic kidney disease 4 years before it happens, worked in a backdated trial using Janssen, so part of Johnson & Johnson. They also have they're developing a test for endometriosis, which affects 1 in 9 women, and oxidative stress. So these are trading around 52 cents. I think over time, a triple figure stock. Martin, real high quality company, backed. This came out of the CSIRO. They do have a lab in Netherlands, WA, where they test the proteins of the A2 milks. They do have a laboratory services division as well. Now, moving on to the miners. This has been interesting because the gold price is $1,901 US. Silver, which I mentioned as the best commodity you could have, is $22.71. And interestingly, the gold to silver ratio peaked at 124. It's now down to 83.7. And suddenly everyone wants to know silver stocks. So this happens with uranium, it happens with lithium, kryptonite, Imodium, all these things people want to lose money on. But so basically I saw this silver thing coming, so we went on and bought 10% of a little company called Red Metal, which has one of the largest undeveloped silver resources in Australia, and they have 2 of the biggest silver targets in Australia. So they've come from 9 cents up to 13.5 cents. So again, I should warn viewers, Martin, that we hold roughly 10% of the company, and if they go to the moon, well, of course we're going to sell it. But I think that's what people are after now. You go onto Twitter and everyone's saying, well, what's the next silver stock? The other one people have been buying is Silver Mines SVL. You can always buy an ETF on the market relative with the Perth Mint as well. Next stock, Minotaur Exploration, 4.3 cents, have a big copper target in Queensland they're about to drill. That's a really good stock. Oz Minerals are out there funding these small companies into large-scale exploration. So I've dealt with this company for years. They're right in the buy zone. Hammer Metals, code HMX, they're only 4.1 cents. They had some great initial gold results in WA, and they've got the Japanese oil and gas company drilling for them up in Queensland, run by Dan Thomas, former business development manager at Sandfire. So they became quite a large company. And it has Russell and Ziggy from Gold Road. So these went from 1 cent to 5 post-COVID, back to 4. They look good. Another interesting company, Martin, Alta Zinc. These are trading at 0.6%. The caveat is there's over 2 billion shares on issue, but they have a high-grade zinc project in northern Italy. So what happened was the shares went to about 1314. Then Italy was in the news every night about COVID. So the shares got smacked, but it's high-grade zinc. It's close to smelters. And we all know that zinc as a commodity is as sexy as Homer Simpson in Y-fronts. So that's the way it is. I think am I safe to bag out cartoon characters? Yeah, you can't say anything anymore. Can't say anything anymore. But they're the stocks to watch. But the ones I have mentioned before, we have had. I mean, I've been on an absolute roll, but I know it can't last. And to me, it's all about client management. I have to manage every client. We had one stock called De Grey Mining. This is a good example for the property market. He bought it at 6 cents. It's trading at 97 cents. This is 16 times your money. I said, look, hit the bid at 97 cents. He says, no, put it for sale at 98 cents. And I'm thinking, I said, you're always a bridge too far. That's what I'll say to someone, a bridge too far. So we hit the bid at 97 and the stock fell to 59 cents. So that's what you're going to get with the property market as well, leading into it, because people are going to think that they're going to get the 2017 high again. And a place that was worth 2 million suddenly drops to 1.5, and they're thinking, well, I'll sell when it gets back to 2 million. Suddenly it drops to 1.3. And that situation is going to be multiplied in the property market. But I'll tell you what, in the stock market at the moment, there's enough liquidity to get out of those mistakes. But look, I think the stock market is where it's going to be at, to be honest. I think that the property market in Australia, I think, is largely shot to pieces. So I did do a bit of, I was looking at some regions. Martin, I don't know if you have any thoughts on some regional centres at all.
Yeah, I mean, the property market, of course, is not one market, as we keep saying, right? And it is varied, and it varies by location, type of property, all of those things. And interestingly, I've started displaying some recent price information of property that's publicly available, on the portals, but trying to illustrate the point that actually, if you look carefully, you can see quite a lot of examples where properties have actually dropped. And, 10 to 15% drop from where they were is quite normal, right? Up in Queensland, we're seeing prices now that are actually lower than they were in 2012, 13, 14 in some cases. And of course, in the West, in Perth, again, we've seen prices come back down. Now, people have been asking me then, well, does that mean that, those mining areas in and around the West or up in Queensland, are they now buys? My own view is, I don't think they've come back far enough yet, but they could become interesting a bit later if prices drop further, because the ratios are still quite extended, even where they are now compared with where they were, right? Now, if you look at some of the other regional centres, and I look at places like, Wollongong and Newcastle, good examples of regional centres, they are still falling and actually falling quite fast. So I think there's more downside there. And I think that quite a few of the regional centres in Victoria, and in fact, Victoria generally, I think we're going to see some considerable drops there. But then if you look at places like Adelaide, that's holding its own at the moment. So maybe there's some places to look at there. But of course, they haven't had the run-up that we've had in the East Coast. The one I'm most concerned about, though, is Tasmania. It looks to me as though all the indicators have started to turn really negative now with regard to property in Tasmania. And I see massive drops in terms of the average rentals that are being actually commanded now. We're seeing quite a lot of lift in mortgage stress in Tasmania because a lot of the economy was linked directly to tourism, and that's pretty much frozen at the moment. So I think that Tas is a little bit cautious about. And generally, my own view is I think that there is very little reason to do anything quickly on property, other than maybe if you've got a lot of equity you might want to sell, because I think the next year to 2 to 3 is going to be more down than up. But it's not going to be uniform, and there will be some opportunities. The other point to make is, of course, Tony, that it depends whether you're looking at it for somewhere to live or whether you're looking at it for an investment. I put a post out tonight using the Nucleus Wealth property calculator, which I have to recommend to people. It's brilliant because you can put in all the parameters and see what might happen. It's very, very hard to make an investment property pay based on all the parameters that we currently have at the moment. But if you're buying a property for somewhere to live and you're happy to live in it for 5 to 10 years, you can probably ride it through. And I think that's one of the key points. You still need somewhere to live, and then it becomes do I rent, do I buy, do I rent, do I buy? But with rents dropping, many people can actually do better to rent for the moment and just let the prices die a little further, because I don't think they're going to go up. I think they're going to go down from this point.
I think it's, the work from home conundrum, really, because I actually started looking at some regional areas. I picked some nice little places in New South Wales I like to live. I looked at Mudgee, and it's 440,000. It's not that far off Perth.
Yep.
So to me, the speculative money, instead of turning towards Adelaide, just went down to Hobart. And Hobart is the biggest lobster or cray pot I've ever seen. Yes. Easy as hell to get into, but try and get the hell out. That's what it is. Hobart is a lobster pot.
Yep.
And you look at Adelaide, I think people say Adelaide's boring city. What rubbish. I think at some point, once we see a further correction, both Adelaide and Perth, I believe, will be the places to live. I mean, I love living in Perth. As I say, I'm 4 kilometres from everything, and I pay SFA in rent. I rent vest, so that's what I'm doing at the moment. But so I think these regional areas. I actually looked at the median house price in Broken Hill. It's $130,000.
No.
Now I don't know what the NBN's like out there, but why not go live out in Broken Hill? Create your own cafe culture and have your own chocolate fine arts shops. I mean, it's shelter. I don't think it has the volatility of mining towns such as Queensland.
Yeah.
And I was actually horrified at the Channel 7 story on the Mount Druitt Millionaires Row.
Yeah.
I don't know if any viewers watch Struggle Street, but from my experience as a police officer, I saw those issues, and that was like housos on steroids. But I was looking around Perth and I was thinking, well, I think I found the next Mount Druitt, Martin, and that suburb is called Camillo. It's 30 kilometres from the city, large blocks, close to Kelmscott, Armidale. Median price is $217,000, and there's plenty of houses in that area you can buy for $180,000. And, I mean, obviously there comes a caveat. You've got to have areas of higher social unrest, higher crime, more donuts on the street, not the ones you find at Krispy Kreme, lawyers waiting for them. But if people think that how can Mount Druitt go from the ones to the high sixes? You know, certainly if you look at the cheaper suburbs in Perth, a lot of them are around Kwinana, but you can still buy a decent house within 30 kilometres from the city. And I think that's what people have to look at. Do they try and go regional, or they say, well, wait a sec, we can live in a beautiful city, admittedly where there's some high crime and a bit more of a commute, for less than $200,000. And I think that's going to be the trend with, you know, working from home. They're all talking about regional areas. I mean, trying to pick a regional area is pretty hard. I mean, do you go to Wagga Wagga, which was, I think, the happiest place in Australia in 2011? But what do you pay? $470. So, I think you're going to have pockets of regional bubbles. I can't see property developers just going under a rock. No way. I think you're going to see some areas pushed pretty hard. But, yeah.
So what do you think about the Western Australian land rush, right? So basically there was the home builder thing, which was federal, and then WA basically said, well, we'll top it up. So you can get, $55,000 if you sign up for a home land package. And there's been a 170% rise in the number of sales in the last month relative to a couple of months ago. A lot of people seem to be rolling into that. Is that sensible, do you think?
Yeah, there was actually a story. They were laying the first slab under that government program, niche living. So when I was selling my place in Perth, this was 18 years ago, I actually sacked my real estate agent, and he now runs niche living. So Ronnie El Haj, well done. My loss. But here they are, you know, they've got all these, you know how they shovel, you know, they're pouring the slab. Look, there's plenty of land available in Perth. These estates are quite nice. Look, they're moderate downside, low growth. It's a case for these couples to be able to serviceability. But you're still looking at multiples of some of these established suburbs where you can buy with the one in front of it. So I don't know. I mean, I've gone from living in a one-bedroom unit in Bondi to a house we built in Victoria Park, Perth, and it doesn't change how you feel about yourself as long as you've got a bit of natural light. I don't know why this rush for mansions, but look, I think it's a worry where all these people are flooding into these properties in Perth, and niche living. He said his business is through the roof. Yeah.
So, well, that's certainly what I'm seeing from my data. But of course, what that does is increase supply, and what it does is put downward pressure on existing property. And I keep reminding people that Mandurah is now 38% down from peak, right? 38%. So, you know, and prices in Perth on average went down over the last quarter again. So we haven't hit the bottom yet, right? So people, I think, need to be very cautious over there, and, you know, just piling into this homeland package because all the governments are giving you money may not guarantee you growth into the future. Now, it goes back to my point. If you're buying for somewhere to live and you're happy to live there for a reasonably long length of time, then maybe okay. But if you're thinking about a quick buck from an investment perspective, don't hold your breath when you take into account transaction costs and all the other things that you have to pay when you actually go and move into somewhere, or, you know, all those things. It's always more expensive than you think. So I think people should be a little cautious about that.
Yeah, well, it's a tale of two markets, isn't it? Because you've got, let's face it, I pulled up a chart of Northern Ireland, that Northern Ireland house price index from 2007 to 2013, and that's exactly where we're heading, eastern states. Yep. I mean, I don't know if I'm sure you'd partially agree with that summation, but that is a pretty scary looking index. So that was 198 all the way down to 91. And I think if Australia can escape with something like that, because you've got to remember is house prices, it's all relative to wages, the cost of money, the economy. Well, this is the worst we've seen since the Great Depression.
And 9.5% unemployment by the end of the year. 9.5%. You know, people have not woken up to that number yet, right? Because the thing that I want to underscore is that whilst quite a few of the early jobs that were actually squeezed out were part-time and casual workers, what we're now seeing is hardcore unemployment as major companies actually right size and downsize. So you look at consulting companies, you look at the retail sector, or you look at the financial services sector, you look at airlines and tourism. You know, these are mainstream jobs disappearing, right? And that is going to hit precisely the more affluent areas, the people with a lot of mortgages, probably investment properties as well. That's what people haven't come to understand yet. Now, I've lived through a few different property cycles, and I've seen what happens when unemployment rises and with everything else. But 9.5% is enough to really make a lot of people very uncomfortable, and I think some will be forced to sell.
Yeah, it was funny, on SBS World Movies during the week, they had 99 homes followed by Margin Call. And so I ended up watching them both again, but you could feel the angst of these people, you know, cash for keys. I mean, what did we have in Australia? Cash for clunkers, which I think failed. But what's going to happen when we've got, it's going to happen. There's no other way of avoiding this when all these estates 60 kilometres from Sydney in these so-called pristine suburbs with man-made lakes and all that. What happens when everyone's $300,000 to $400,000 in negative equity with no income?
Yep.
What's going to happen? Are we going to see similar scams to what was in what Andrew Garfield did in 99 homes? I just don't think people realise what's coming because the scenario is there. And the last time we had affordable housing in Australia was coming out of the early 90s recession. And then the uptick happened in 95 when wages and house prices went under that great disconnect. So it's been disconnected ever since. But when you've got an economy similar to the Great Depression, how can you justify 11 times price to income? And people say, oh, Locantro, you're back to price to income. Well, I use that ratio similar to a PE ratio. And that's it, because we're going to have those ratios have to fall. And we also got to have contraction in PE ratios as well, which means I think that, you know, banks like Westpac, share prices recovered from the 13s back up to almost $18. That's a raging sell. You're going to see an earnings collapse here in Australia. The stock market and the US are still priced for absolute perfection, and so is property. It's still priced for perfection. And I had a case in one stock last week where a client picked up the stock and within an hour they were up 3 times their money. And I said, it's time to sell it. And he said, why isn't the share price falling? And I said, well, you're the first one to sell.
Yep.
And as I keep saying, if you're going to panic first. But look, I've paid attention to markets. I've looked at the rentals down Leederville area, the commercial. And you know what I'm seeing? I'm actually seeing businesses with established clientele moving into gaps filled by specialty toy stores. So what's happening is these businesses that already have their clients are just negotiating cheaper rents, and they're playing musical chairs to get the cheaper rent. So you're thinking, well, this area is thriving. It's another barbershop, which luckily I don't need at the moment. But, you know, male grooming's become a bit of a thing. We've had all these pampering because people have started to pamper themselves during lockdown, but it's not a thriving new business. It's just musical commercial chairs as far as I'm concerned. So, look, that's a bad.
I'm watching the commercial real estate sector actually even more firmly than I am the retail property sector, because if you think about it, actually they often will turn turtle first, right? And bearing in mind, down the eastern states in particular, there are thousands and thousands of empty retail units now, many of whom are, of course, effectively in property trusts and in other structures that essentially will not be able to pay what they normally pay because they've got nobody in them. And I've also noticed that the momentum in terms of construction in the commercial sector has pretty much stopped as well. So I'm afraid all of those things are likely to come through first. I think the retail, impact will come first. I think that the residential property stuff will take a long time to grind. Remember that in the US, it was about 3 years after the global financial crisis for price defaults to prices fall and defaults rise to their peak. I think that same cycle in terms of longevity will probably be apparent in the residential sector. But the commercial real estate sector, I think we're watching it already grinding down. And I think that that's where a lot of the issues are. Remember, the banks are highly leveraged into that sector as well. But a lot of super funds are also highly leveraged into commercial real estate. And I think that a number of superannuation funds are going to be really struggling to get returns. I wouldn't be surprised to see some negative returns over the next year or two from there. So, it just again shows you that while there are some good stories and some bad things, there are also some pretty ugly things going on too.
Yeah, I think super funds are going to have to reprice liquid assets. I mean, good luck with that. But what I've noticed is it's been the demise of the fax machine and the rise of the electronic signature. I mean, you don't need a friggin' office anymore.
Yep.
That's it. I mean, yep. I've had the best couple of months of my career recently. I've worked hard for it. It's finally something's gone in my favour. But I went out for retail therapy, and I think my retail therapy is like my addiction to a bucket of KFC. You get that feeling about once every 4 to 6 weeks? I don't know. It must be something in the herbs and spices. But, I mean, I invested in a new monitor, so I've got the new monitors, I've got some lamp, this new setup. That's as much retail as I can spend. Admittedly, I've got a cupboard full of polo shirts that are a bit tight on me now. But, I'm going to go out and start to work on the fitness and that. But I've just got no interest in spending money. I mean, who needs a retro toaster and kettle, for God's sake? I mean, I don't know. But I just think it's really sad what's happening to retail. No one, honestly, how many meetings travelling interstate are essential, to be honest? I mean, I've had that many Zoom meetings and they're awesome and they're, there's none of this travel. I mean, I live 4 kilometres from work, but if I work from home, I save an hour.
Yep.
I can sit here in my wife fronts, tossing millions of dollars in shares, and no one sees me. It's awesome. It's awesome, but it's sad that we've over-invested in things that have just become obsolete so quickly. And I think that's the story of McMansions, soccer mum SUVs, all this consumerism. All those brown alphabet Louis Vuitton bags you see. Everyone I see of them, I say it's a fake. It's a fake until proven otherwise. I mean, we've gone from this hell-bent consumer society, and sadly, it's taken a virus that isn't over yet. I'm still bracing for the worst here in WA, but this isn't going away, and this is going to reduce less is more economy. But the sad part is, Martin, we're in a shitload of debt. And at one point, 200% debt to income ratio. How can any country survive on that? How can any personal balance sheet survive on that? So I think, sadly, yes, the next generation are going to have a great life, more reminiscent of the 70s. But how many positives can you see coming out of this?
Well, it's certainly tough. And, everyone's that I speak to who are saying things like, well, but won't the Reserve Bank just keep, basically printing more money, and won't the states start buying property so that they can actually take some of it off the market and relieve the stress on the banks? And my reaction to that is, sure, they can. Yeah, they can do that. The question is, how much of that would they need to do to be able to really stop the rot? And when you actually do the calculations, the amount they would need to do to really stop the rot is more than I think is feasible for them to do. And,
well, you throw the dollar under a bus, don't you?
Well, you do, yeah, exactly. And you also, of course, have got many other things and many other priorities. So it's not like, one, let's save the property market. 2, let's save the banks and never mind everybody else, right? There are many other calls on those funds at the moment, particularly with the high levels of unemployment and those things. So there will be some attempts, I'm sure, by government and by the Reserve Bank to prop things up. But my own view is it's probably not going to be very successful. And I do think that there's going to be a bit of a reset. And then, of course, the question ultimately, Tony, is, well, if that's true, and if we're going to see unemployment at 9.5%, and as you made the point, stock market's a disconnect from reality, does that mean the ASX is going to come back? And if so, do you think it's going to be this year or next year?
I just can't see these valuations being maintained on the ASX 300. I mean, I switched my clients pretty much into gold producers late 2014 out of the banks. And the bank prices outside of the Commonwealth have actually halved over 5 to 6 years. And Westpac down in the 13s. I mean, that's an absolute catastrophe. So I still see it $11, $12 with maybe a $10 rights issue, give or take. I don't think we've seen the worst of it yet. And markets that reach a permanently high plateau, like they did in 1929, create this false sense of security, and that's come to every market, property markets. I mean, as I said, if people aren't trying to sell their house now on the eastern seaboard, Sydney or Melbourne, if you need to get out, you've got to get. It's probably too late, unfortunately, and that's not a good thing. But this window to get out has been open because I mistakenly called the top around $1 million on the Sydney median. It went to 1.157. So I missed the last 11% of the stupidity. But that stupidity occurred in 2017, where everything, real or not, was running. The world just went crazy on speculation. At some point, maybe 2021, the world will go crazy on capitulation. And unfortunately, when that happens, it leads to more calls to Lifeline, more suicides, more crime, more stress, more family breakdowns, and the mother of all economic depressions, Martin. So, look, I feel that, whilst I'm not driven by labels or fancy cars or women and all that stuff, we need money to survive. I think you have to, and, obviously the smart money is moving to certain areas, but you know what happens when the dumb money moves in. And the dumb money can go on a lot longer than anyone can think. And all you need to do for that example, Martin, is pull up a chart of Tesla or Afterpay. And you see how long dumb money can go for. And I think the worst thing any investor can do is try and naked short sell something. Try and short something, because there's always a greater idiot to pay more, or some pension fund that will come in and take the lot at the top. But I'm a positive person, but I've got to remain positive on areas where I can look after my family, make some money to survive. Luckily, my biotech and mining stocks have done well for me, but that's 22 years of hard work. And no doubt your hard work is providing your views and, the respect you deserve.
Well, I've enjoyed this conversation, as always, Tony, and we should, I think, just caveat, this is not financial advice. This is just a general conversation about things we're observing, just so that there's no ambiguity about that. But as always, if people do want to find out more, we'll put the links below so that people can reach for you, because I think you've got some very interesting perspectives in terms of small caps. And I do agree with you on property. We've both had a heated agreement for the last couple of years, and it's all coming good, I fear. But, the bottom line for me is that there are people who need to think seriously about whether it's time to get out. It may be too late. My own view is it's getting close to being too late. Prices are falling, but nevertheless, there's still a small window for some people to really take seriously, particularly if the income equation is looking stretched and there's equity sitting in the property. But, we're in tough times. I think the tough times will continue, and I think it's going to get a lot more ugly ahead.
Yeah, and where else can you be tipped the next Mount Druitt, Martin? That's it, DFA.
Look at my data. There's some interesting stuff there. Good to talk to you, Tony. Take care.
Absolute pleasure.
See you soon. Cheers. Bye-bye.